Welcome back to Mortgage Markets and More. I'm your host, Peter D'Angelo. Welcome to Friday, everybody. I hope you all had a wonderful week. I'm excited to share our regularly scheduled programming. Plus, we're going to have an extra segment that we're going to be including every week, and it's going to be called Did You Know?, where I'm going to share one brief fun fact about something mortgage or real estate related that is hopefully going to be helpful for you. And if you do have questions about it or would like to learn more, you're encouraged to reach out. We will start at the top with our normal review of the bond market as well as the current interest rates as of recording this podcast the Thursday before its release. So the latest and greatest currently is the 10-year Treasury bond yield is at 3.79. That's up just about 0.1%, give or take, from last week. The 5-year Treasury yield is now at 3.52%, and the 2-year Treasury yield is at 3.53%. So we're still seeing that this is starting to flatten even a little bit more now. We're seeing that 2-year come down, a little bit more of a spread between the 10-year and the 2. And that 2-year still just a touch above the 5. Once that starts flattening out, then we have what we call a flat yield curve, and things are starting to be a little bit more quote-unquote normal in how the trading happens there and what those yields look like. The reason why that's important for us is that the bond market is heavily tied into mortgage interest rates, which now we will get into the Mortgage News Daily survey of mortgage rates as of recording this podcast. So the 30-year fixed rate mortgage is at 6.19%. The 15 years at 5.55%. The 30-year jumbos at 6.4%. The 30-year FHA is at 5.76%, and the 7.6 SOFR ARM adjustable rate mortgage is averaging 6.17%. This is the highest level that they've been in the past 2 weeks, but not by much. We're still on the very, very low end of the 52-week survey, taking a look at where interest rates have been over the past year. We're still toward the very low end of that. I know you're wondering right now, we just had a Fed rate cut. We talked at the last episode about how that Fed rate cut was something the market was expecting. Why are rates going up a little bit? It's due to the volatility of the situation. We still are going to be keeping an eye on inflation. We're going to be keeping an eye on jobless claims and what the labor market's doing, because this is going to inform monetary policy for the Fed when it comes to future rate cuts. For example, right now, the market has an expectation of around another 75 basis points or 0.75% in cutting the Fed fund rate, which now is in the range of 4.75 to 5% after the half a point cut that we had last week. That being said, from the horse's mouth, we had the dot plots from the Fed members. There's 19 members of the Federal Reserve Board. And the last meeting, like I mentioned, they put pen to paper and kind of put out what they expect their monetary policy to look like, provided the data and the information is consistent with the trend that we've been seeing, and they have about 0.5%. So yet again, we're in a position comparable to where it was back in December and January going into the new year here in 2024, where market expectation was not in harmony with what the Fed was planning out as far as what they saw as likely rate cuts and what their monetary policy would look like. When that happens, we have volatility. So even though inflation's moving in the right direction, the unemployment rate ticked up. That's a little dangerous for the economy because people not having jobs, they don't spend money in the economy, and that's a problem. So the Fed is quite fixated on that right now as part of their dual mandate, where they have to look at inflation and then look at the economy and making sure that Americans still have jobs. So with all of that in consideration, we're going to be seeing how things develop. And this is actually a jam-packed week. So unfortunately, as of recording this, I'm not able to provide you with some information, but I can update you next week. Or if it becomes really impactful, stay tuned. We may have just a special episode drop next week just to address some things that may be going on. Because here's the deal. Today, when I'm recording this podcast, is Thursday, September 26th, and we are going to get jobless claims. We're going to see a bunch of Fed governors speak. So these are the members of the Federal Reserve Board. They all throughout the day on the calendar right now have different moments where they're going to be making commentary. The market's going to be looking into that closely. So we could see some more volatility today if anybody's comments are inconsistent with what we were presented with last week. And that's how these things develop. That's how these interest rates move. So we've talked in the past about how just because we heard that the Fed cut the interest rate for the Fed fund rate doesn't necessarily mean and necessitate lower interest rates. It really has to do with the market, because the market's always projecting out. And that projection expectation that the market has is what creates the lending environment. That's the money that's going into the market that's actually affecting a little bit more directly than the Fed fund rate where the interest rates are for everything, not just mortgages. We're talking auto loans, credit cards, personal loans, the like. Now for our Did You Know segment. We're going to be doing this every week, and I'm very excited about it. So today, very simple. Did you know that as a first-time home buyer, you have access to a loan program that allows you to put as little as 3% down? That's right. So it is a conventional loan program, and you can put as little as 3% down if you're a first-time home buyer. And then here's a supplemental kicker. First-time home buyer, it's outlined as making sure that you haven't owned property in the prior 3 years. That means as long as you haven't been on title to a property in the past 3 preceding years, you are considered a first-time home buyer. You have access to this loan program with as little as 3% down, and it could be supplemented by even better first-time home buyer programs. So bear that in mind. Now, in the market, full transparency, 3% down isn't a very strong offer looked upon by sellers. However, we offer a power bid approval, and I found that to be very effective. So essentially what we do is we take you as if you're under contract right now and you want to get your mortgage all set up. We actually do all of the work for your mortgage with respect to what's required from you as a home buyer, and then we issue a mortgage approval. That has proven to be very helpful, particularly if you're interested in low down payment for making your purchase. It gives me the flexibility and empowers me as your advisor to then contact your buyer's agent, the selling agent, to go to bat for you, letting them know that your mortgage is already done and that we can accommodate a closing timeline that's as quick as the seller's amenable to. And it gives them the confidence of knowing that we've already taken care of everything for your mortgage process with respect to what's required for you. And then the rest of the process runs with all the property specific things. So that's our Did You Know segment for today. I did want to spend a little time today because this conversation has come up quite a bit recently, particularly after last week's episode and talking about interest rates coming down and how that can affect buying power and how it could make it a little bit more accessible and maybe could be the deciding factor for those sellers that have been on the fence or would-be sellers to make the decision to sell their home and upsize or downsize. We went through the upsize scenario last week. However, what I've been talking to people about is, hey, when are interest rates going to get down to like 3% again? Are we going to see interest rates around 3-4%? I have a very fleshed out perspective on this. This is my own personal perspective, but I think it's valuable and I think it's worth consideration. And I also welcome anybody to the contrary. So if you do have a contrary perspective, let me know. But I'm going to lay this out for you, and we have to roll the clock back to support where my argument stands here, all the way back to 2008 and the Great Financial Crisis. Now, the Great Financial Crisis was precipitated by easy access to funding. There were pretty much no guidelines. If you had a pulse, you could get a mortgage. And there's a lot we could go into with that, but it's sufficient to just leave it at that. 2008 happens, the Great Financial Crisis roils the market, the economies. We go into a recession for years, and it's brutal. And what happens during that time is that the Fed got involved to support and stabilize the market. One of the things that they did was they lowered their benchmark interest rate, the Fed funds rate. That went down to 0. So that means what we've been talking about pretty much every episode, talking about the bond market and then also talking about the Fed fund rate, which is now at 4.75 to 5%, that was 0%. So as you could tell, going to 0%, that influences lending rates because now lending rates go down. When you have lending rates go down, that helps to stimulate the economy. When you make money more accessible, more people have access to money. When people have access to money, they take it. When they take the money, they put it into the economy. They invest it in the market. Or just for purchasing goods at a consumer level, they have more money to do so. So that created the lending environment that we saw from 2008 all the way up really through 2021. It's a long, long time. And I want to stress the fact that that is not normal, nor is it healthy. So that's not the only thing that the Fed did. The other thing that they did was we talk about the bond market a lot. The bond market, we talk about yield. When we talk about yield, we're talking about bonds, which are federal debt that's for sale so that the federal government can have funds to balance their budget, have income. So the U.S. government sells their debt in these different duration bonds so that people can buy them. They buy them at a value, and they will pay out a certain value at the end. And the difference between what's paid and what the value is at the end is the yield, and it's expressed as a percentage, which is what we just went over earlier. When 2008 occurred, other than just lowering the interest rate, that's one lever that they pulled, they also implemented something called quantitative easing. Quantitative easing was the federal government themselves stepped up into the market and actually infused money to the bond market, purchasing their own debt. Why would they do something like that? If you don't have enough buyers to buy the debt in the bond market, right? If you don't have enough buyers to buy the bonds, that means the people bidding on the bonds are paying less money for those bonds. The value at the end of the duration of the bond is the same, but if they're buying at a lower price point, that means they're getting a very high yield. And if there's not a lot of buyers there, that means the government's spending a lot of money to get little money for offsetting the debt that their intention is to sell, which is through those bonds. The federal government gets involved and the Federal Reserve gets involved, and they're infusing money. So as the government is putting the bonds up for auction, the Fed is coming in and also buying the bonds. That creates competition in that marketplace that helps to stabilize the price of the bond that someone's going to pay, and that makes sure that the yield doesn't drop tremendously or doesn't grow tremendously. So it's just trying to stabilize this so that yields are consistent and that the debt is purchased. So between quantitative easing and the lowering of the Fed fund rate, these were the two things that created the mortgage lending environment, from 2008 to 2021. That's what got us those 3% rates. Reason why I'm setting all of this up for you is that it's simple economics, that if you make money more accessible like that, more people will spend it. That's great for the economy. But with the yield that's being generated from low interest rates, that's not good. That is actually an indication of an unhealthy market. So I joke, and when people ask when are we going to see 3% interest rate, my common response is, if mortgage rates are at 3% again, a mortgage rate's going to be the least of your concern, because very likely whatever that environment looks like that created a 3% mortgage rate again is an environment of extreme financial crisis. And as we looked, the last time we had ultra low interest rates was after 2008. I think just very simply stated, it could be as simple as that. The only way we'll see that again is if something akin to 2008 happens and the federal government has to get involved to stabilize and stimulate the economy. It could be that simple. Now, I don't want to just give you all the negative news. Let's talk more positively here. The Federal Reserve is making their decisions on monetary policy and starting to move things in a better direction to make capital a little bit more easy to access, money easier to access, which is great. So we're on the right track. However, if you're going to be waiting for that 3% or 4%, it's not going to happen without something kind of catastrophic occurring. So it would be best to take a look at last episode again, listen to where we discussed what that buying power looks like when you're selling to upsize. Downsizing is a slam dunk as the rates are starting to come down. I'm of the opinion that around 5.5% interest rate would be excellent. And not getting there too quickly because it would shock the market. There's also, if you recall back in 2023 and 2022, we had, regional banks were really in a tough spot. And if interest rates drop very quickly, interest rates for lending will drop, which is great. It's more affordable to buy something. However, for those of you who have your money in online savings accounts and money market savings accounts, the yield that you're going to be getting on those accounts is going to go down. You're not going to be generating as much interest income from the interest rates on those accounts. So it's kind of a catch-22, But on balance, if rates drop significantly and quickly, the rates for those deposit accounts are going to go down. You're going to have a lot of chaos in the banking sector because people are going to be trying to lock in highest yield that they can get in these accounts. They're going to be moving money. That could put stress on regional banks, the likes of which we've already seen when there was the bank run on Silicon Valley, First Republic, Signature Bank. These are a few that were collateral damage during that time. Something like that could start happening again. On the lending side, we drop rates really quickly. So if we go from where we're at right now, I mentioned we're at 6.19 is an average 30-year conventional loan interest rate across the country. If that 6.19 goes to 5.19 overnight, look out, because now that's a ton of buying power that just got translated into the market for people who either have been shopping or have been on the fence about buying a home. If it drops that quickly, buyers will flood the market. We could see home values appreciate rather quickly because there's going to be more competition and more competition with people who will have more capability because the lending rates are affording them more buying power. So my hope is that as we're continuing throughout the rest of this year, we see inflation still to come down, meaningfully to reach the 2% target. We're going to see, hopefully, that unemployment rate come down, the jobless claims starting to soften, and, a more healthy labor market, and interest rates slowly to work their way downward. And I really do think that as soon as we get on average below 6%, we'll be in pretty good shape. And the last point that I'd like to make for this argument is that if you do a survey, and we just roll the clock back to 2019, average mortgage rates were in the 5 range. We were at the high 4s to low 5s in that range there in 2019. COVID was an outlier. COVID was something that, it was, we didn't know what was going on. It's the first time that we've ever had to experience something like that and manage something like that. There was a lot of economic stimulus that happened, and it kind of promulgated that quantitative easing and stimulating of the economy like we talked about it just now. So we just kind of remove that. If we just pick up the ball where we left off in 2019, well, that's where interest rates were. So if we've been in an environment where interest rates were all the way up to 8% at one point for a 30-year mortgage, and now we're down to 6%, if we can get just below 6%, I think that'll be a very nice sweet spot, which won't introduce too much chaos, but will be some relief for those looking to purchase their first home, move up, or move down. And those are my thoughts on the interest rate environment and why we probably won't see 3 to 4% again. However, the one asterisk here is that if we see interest rates go into the low 5s, you could pay what's called discount points, where you pay a premium at closing and you're locking in a lower interest rate. It's not a one-to-one. There's not a one-to-one calculation. It's based upon how the market is at that time and on that day. But that is something that you can do. So will it be attainable to have an interest rate with a 4 handle on it in the near future? Possibly. If we see interest rates on average start reaching that 5.5% level, it will be within range where you could pay that premium up front to have that lower interest rate and lock that down for 30 years. That is it for me today. I hope you found this helpful and useful. Please like, share, subscribe. If you know anybody who's interested in real estate, a real estate professional, or anyone who's generally had conversations with you about possibly buying or selling, this is a great episode to share with them, as well as the podcast. Please share it. You can reach me on my cell at 973-800-2538 with any questions. Also, you're welcome to email me with any inquiries or anything that you'd like covered on the show, or if you have any responses to anything that I brought up today or at any other point in future episodes or past episodes, you can always email me at peter.d'angelo, spelled D-A-N-G-E-L-O, at rate.com, and I would look forward to connecting with you. In the meantime, have yourselves a wonderful weekend, and I look forward to catching up with you next week. Take good care.